So are we going to have a collapse in real estate deals, as it were, in 2023? I think so. I think we're going to have a lot of pullback, and here's why. Okay. Well, first of all, interest rates are going through the roof. I mean, they're really going up. Now, I know if that scares you, I want to give you some context. I remember when I started in the real estate business 44 years ago, I was 18 years old, interest rates were 18% at that time. And I remember doing backflips when they hit 7%. So, you know, we're there now. It's a 7%, and it's going to keep going. The Fed is going to keep raising rates. There's no question about it. It may not be as aggressive as it was this year, but it's going to continue because it hasn't slowed down inflation yet. As these interest rates go up, real estate values have to come down. I mean, in the single family space, you've already seen about a 20% drop in sales. I think it's going to probably double that number in the near future as far as the decline. And as interest rates go up, so do cap rates. And you know, it's counterintuitive. The higher the cap rate, the lower the price. The lower the cap rate, the higher the price. And so cap rates are going to go up as well. So the value of our commercial real estate is going to go down. And so, you know, in my opinion, everything's going on sale, and there's going to be some great deals. But let's talk about bridge debt for a minute, okay? If you don't know what bridge debt is the commercial real estate version of hard money loans in single family. So if you ever got a hard money loan in single family, high interest rate, short term, stuff like that, bridge debt is the commercial real estate equivalent of that. And it's adjustable rate debt. It's short-term debt. So, you know, interest rates have gone up, and there's been a lot of bridge debt written these last couple of years, with or without rate caps. If you got a rate cap, maybe you got a 2% rate cap so that the interest rate couldn't go up more than 2%. You paid a lot for that. But I'm going to tell you, a 2% increase in a multi-million-dollar commercial real estate property is a big deal, okay? And a lot of this bridge debt is coming due. And these guys that bought these deals using bridge debt because it had higher loan to value and it was easier to get and they were able to borrow more money and have show better returns, prospective returns to their investors, are going to have some trouble because they didn't factor in the fact that, you know, they've got to figure out either to refinance or to sell. Now, if cap rates have gone up, it's going to be harder to sell because the value's gone down. If they want to refinance, interest rates have gone up, it's going to be harder to borrow money and still be able to satisfy debt service requirements. Okay, there's something called debt service coverage ratio. It's the property's ability to service the debt, and it's going to be hard. So there's going to be some serious pain, and I think there's going to be incredible opportunity for people to snap up these properties. And so I'll give you an example. We were looking at a deal in San Antonio, and the bridge debt was coming due, and the guy's reserves with his lender were $10,000 a month. They went to $80,000 a month. Okay, that's a big freaking deal, right? So I think there's going to be incredible opportunity. I think real estate is going to really slow down and crash here a little bit for the next year or two. And so, again, not something to be fearful of, something to get excited about and prepare for. I'll see you on the inside.